I'd just like to thank everybody and welcome them to the third quarter review from TAM Asset Management. I'm pleased to say that our assets under management are going to be up 30% this year in what's quite a difficult year, supported by new strategic partnerships and new relationships with the IFA market. We've all been bound in the last 3 months by our consumer duty issues, and TAM moved very quickly to support IFAs with new liquidity products, which it put out to clients maybe a month ago and is receiving traction. I think more importantly also, I'd like to thank all those who've supported us during the first 9 months of this year, but also for those that have helped us with our charitable giving, because we've managed now, since our inception on this, to raise over £300,000 for the good charitable causes, and we really appreciate that.
Markets in the third quarter have again been interesting. 2023 has been a very interesting year for investing. Much of what we've seen in the third quarter has been slightly lower volatility, but it's been maybe a moderation from what we saw in Q1 and Q2, which was very much this parabolic rise of AI and tech stocks. You saw a little bit of that euphoria coming off in the third quarter. What you started to see was a little bit more positivity coming back into the rest of the market. If you look at the US S&P 500, you started to see companies that weren't involved in tech, that weren't involved in AI, more like banking, more like industrials, more traditional sectors doing very well. So that positivity that you saw in Q1 and Q2 was spreading out, was broadening out. So you saw investments that maybe weren't tech focused starting to do well again, and that was really good for a diversified portfolio like TAM, is because we were able to see some of those investments that weren't involved in tech starting to rally. As you move through the quarter into the back end of the quarter, that's when it started to get really very interesting, because we're right in this phase of inflation, and inflation coming down to around the 3% mark. And everybody's been watching this inflection point, because the debate is now turning to whether we can get from 3% to 2%, which is the global central bank's target. And we've started to see that coming to the fore in September time, so in the back end of the third quarter. And you started to see that coinciding with the rally in oil. So oil has started to come back again. And oil, obviously a rallying oil market, is in inflationary pressure. So you started to see a lot of fears emerging about inflation not coming down in line with expectations. Therefore, interest rates are going to stay higher. So you started to see those old animal fears around higher for longer coming to the fore. Obviously, that means that higher rates, greater chance of recession. So you've started to see a little bit of concern around the R word coming back, especially in the US, that continues to remain very strong. Europe and the UK have remained a little bit more lackluster, and you started to see the gains, especially in Europe, come off a little bit. But again, the positivity around rates coming down in Europe is a little bit more anchored, as you've seen that European Central Bank approaching the end of their rate hiking cycle. So you started to see different central banks in different parts of the world, especially developed markets, starting to deviate a little bit. And we're really starting to see that in Q3. It sets us up for a very interesting start of Q4 and the back end of the year. So as we move through into the final stages of 2023, where do I think markets and portfolios are going to go? It's going to be, again, very, very interesting to see where the inflation narrative pushes the stock market, because the inflation narrative is governing where people are putting their assets. There remains a lot of money on the sidelines. There remains a lot of people that are saying, you know what, I don't want to get involved in this market because it's too difficult to call. And I don't blame them. With inflation at 3% in the US, looking to try and get that down to 2%, the ability of the US to do that is very much going to call into question what does well in the US. I think in the US especially, you're going to have a little bit of a problem coming from 3 to 2% on your inflation target, which I think is going to mean that interest rates are going to stay slightly higher for slightly longer than the stock market and the bond market currently expect. What you're going to see again feeding into that is whether the US is ever going to slow. the US economy has been extremely strong in 2023, and a lot of speculators, a lot of investors are starting to look at whether that's going to slow down. And there's a saying, the saying goes, when the US sneezes, the rest of the world catches a cold. That's very much in play in 2023. And you could start to see the US slow down, if there is one from an economics perspective, higher unemployment rates, higher job losses. If you start to see that coming through, you may start to see some volatility appearing in the stock market, which isn't something that we've seen too much of this year. So we're looking out for that. But again, a diversified portfolio of different assets is going to be the best way to combat that slowdown. If you have different pockets of investments in different parts of the world, you can look for that high quality trade across the piece. It doesn't just have to be in the US. And that's very much where we're looking at in the back end of the year, is trying to gain that high quality exposure to large cap companies, to healthcare companies, to some industrials. These things tend to do fairly well if a recessionary environment occurs. And whilst it may not occur and the market may continue to go higher and higher and higher, we want to make sure that our portfolios, and importantly our clients, are prepared for the downside, because that's what TAM's all about, is evaluating that downside and making sure that we're protected.